Welcome back to the psychology of FinTech. Here in this video, I'm going to talk about three scenarios that support EMH to get realized. Okay, as you've seen in the last video, efficient market hypothesis is such an important centerpiece of modern economic theories. Economists have every reason to believe in EMH. Otherwise, their whole theories get crumbled down, right? But, you know, in that sense, we have to set up our skeleton as a building block first of all, and then tomorrow I'm going to give you some evidence against EMH, okay? And that is so important as well. So wait for that. But before that, I have to give you the reasons or scenarios when this EMH could hold. Okay, is it a strong assumption or not? That's something you should assess yourselves. Anyway, theoretical underpinnings of this EMH. Let's go through one by one. What is the economics behind the EMH? And starting point is that the market price is the outcome of supply and demand. Supply and demand, you may think about it this way in your economics 101, but it's much more than that. It will be more like the equilibrium price in competitive market. If the market is perfect competition, okay, equilibrium price, and then the demand curve and supply curve that individual suppliers and then the demanders, individual the companies face and then the consumers face. How is it shaped, right? That's the thing you have to remember, okay? Perfect competition. Anyway, we will see that the EMH can be thought of as a hypothesis about the relative shape and position of supply and demand curves. And then the supply and demand framework is a clear way to think about the difference between behavioral and non-behavioral finance. Are they X-shaped or cross-shaped? Okay, is the serious question. Reminder is perfect competition, right? And especially as a price taker. Remember, you're not a price influencer. You are simply a price taker. Whatever the price is determined in the market, you have to take it. In that setting, how is it shaped? Okay, so supply curve. Okay, let's think about it first. Well, it traces the quantity supplied to the market as a function of the security's current price P. Well, how many shares of Amazon are supplied today? I just made up number. As of today, 500 million shares outstanding, and supply is set by firms on primary market. Primary market, what do you mean? Do you mean that there is a secondary market? Yeah, of course. The stock market that we see today, day by day, is essentially the secondary market. The primary market is the place where you initially float the stock to the general public. If you remember the word IPO, initial public offering, right? That is a primary market. When you first initially sell the stocks of the existing shareholders to a new shareholders or issuing new shares, right? That's IPO, okay? And that's a primary market. And then the number of shares outstanding is pretty much set at that moment. Afterwards, usually the number of shares outstanding doesn't change day by day. Okay, of course, I know. Some of you must be aware of the option exercises, and then the number of shares will be increased slightly or decreased slightly for some kind of exercises of these options, and with some corporate events like stock splits or reverse splits and things like that. But let's get away from that, okay? Those are rare events. 99% of the time, it's fixed. So that's what I'm saying. The supply quantity, 99% of the time, it's fixed in the short run. Day by day, it's fixed. So with the supply curve upward sloping, the quantity and price, right? the quantity of supply, would it increase on any given day simply because the price is higher? And the answer is no. No, it's fixed. So the price will be vertical. Yeah, so graphically you can draw it and vertical line, right? Price, quantity, and then the quantity is fixed in the short run, day by day. Okay? Demand curve, how is it shaped? Okay? Well, other things being equal, if the price is higher, you as an individual investor, the demand amount will be smaller if the price is higher. On the other hand, other things being equal, if the price is lower, then you will demand more of the same goods. Well, the securities may be the same thing, right? So you may think individual demand curve will be downward sloping, okay? But, and then as you aggregate the demand curve of each individuals and then each funds, right, institutions of Amazon.com's stock, right, you may think that the demand curve will be essentially downward sloping as you aggregate those downward sloping demand curves in the first place. So the demand curve, you may think that the demand curve will be downward sloping as you aggregate it, horizontal sum, so that the equilibrium where the demand curve crosses supply curve, the equilibrium happens, and then that's where the equilibrium price will be determined. Okay? Like this, you may think in the first place, a downward sloping demand curve. But I said this is a competitive market, extremely competitive, and you are the price taker. Everybody is a price taker. Nobody can influence the price. Okay? Is it possible? Isn't it somebody like the 세력, like powerful guys will influence the price a certain degree and this way and that way? Let's get away from that. Okay? I know. That kind of things may happen. But in theory, okay, in a very abstract sense, okay? Let's say we are all price takers in a competitive capital market and efficient. Then what happens? Investors are very competitive, and then they are busily hunting for the information, and then they hate to lose money. Okay, they don't want to pay any single dollar more than its true value. Okay, and then the true value, let's say it is P star over here, dotted line. Okay, and the price and then quantity, and then the fixed supply curve is over here. You imagine a downward sloping demand curve, but is that really the case? Who would ever want to pay a single dollar more than the true value? I said no. Okay? So that's why it's going to be a rather horizontal curve, the horizontal line like this. Okay? This is the shape of the demand curve in EMH. Okay? And then if you look at it over here, okay, if the price is a single dollar lower than the true value, what would you do as an investor? You will buy more. Okay, so the demand curve will be flat every instant, right? It will be like this. That's the supply and demand curve shape that any security faces, any investors faces in a perfect competition market. Informationally efficient, perfect competition market. Okay? Some of the Korean students may question, hey, come on, in Korean stock market, as I trade it, I can see 10 levels of, the order quantities of different price levels. And here are the demand schedules, right? Limit buy orders, and then here are the sell orders, the supply. So wouldn't it show a supply curve and demand curve like this? And my answer is no. What you see in the 10 level quote home trading system is not really the demand curve and supply curve that I'm talking about over here. It's only showing up partially. And what you see is, or at the equilibrium price, you see much more supply and demand going on like this. And what you see are limit order quotes at different levels of both buyers and sellers. It's more advanced concepts. I'm not going to ask this question in your final exam, so don't worry about it. But just for Korean students to avoid their confusions, right? Market order, demand, and supply are not visible over here. Market order, okay, is something that you take the price as given and then transact at that level, okay? Whereas this market order is really the perspective of price takers, and it's not shown over here. This is a limit order, right? At a fixed price, at a certain price, I'm going to buy, or at a fixed price, I'm going to sell. Otherwise, I'm not going to do that, right? That's what they are showing over here. Whereas the market order is the perspective of the price takers. Okay, it's not included over here. What is more, latent demand and supply are not shown to the full. So that's why I say it's not really the demand and supply curve that is shown. What you can see in this table is the aggregate limit order buys is bigger than the aggregate limit order sells for this company. And in this situation, investors can infer that price is likely to go down, so we will wait and buy at lower prices. Subsequently, price is more likely to go down. Still, this table doesn't show this X-shaped demand curve or supply curve as you've seen before. Okay. Anyway, so that's a more advanced concept. You don't have to remember all these things. We'll move on. Now, as I said before, what are the scenarios that can justify this flat demand curve? Okay, flat demand curve. Right. The three scenarios can justify flat demand curve. Okay. What are those? Number one, if all investors are perfectly rational, okay, cold-blooded rational, emotionless rational, what would they do? Rational investors value securities for their expected discounted cash flows accurately and use all information to determine the true value. Every rational investors demand a lot more if the price is slightly lower than the true value, and a lot less, even negative demand, or sell short. Okay, so short selling, we're going to talk about what the short selling is about, but wait for that. It's essentially selling first with borrowed stocks. Okay, can you do it? Yeah, you should, right? Is it unethical? No, it's not. It has nothing to do with ethics as long as you borrowed first. Okay, I'm going to talk about it later. If price is slightly bigger than the true value, I told you before, okay, in that flat demand curve, you don't want to pay a single more dollars than the true value if you are fully aware of this true value as a rational investor. Right, that's what I'm saying over here. That's the first scenario that can justify flat demand curve. Second scenario is, well, a part of the investors may be irrational, may be optimistic. They overvalue the stock, and a part of the investors are pessimistic, and they counterbalance each other out. And then the remaining part of the investors, if they are perfectly rational, they will make the demand curve flat, because these biased investors, psychologically biased investors, will balance each other out so that the price will be determined by the group of these rational investors, demand curve being flat, right? Number three scenario is relaxing those assumptions of balancing each other out. Optimists versus pessimists, yeah, and then the existence of rational investors, right? Let's relax these assumptions. So in the extreme cases, you can say that 99% of the investors are over-optimistic, overconfident, so that their valuation estimate is too high, and then they perceive the price is too low and then demand the price so much, okay, and drive up the bubble. Then what? But in the third scenarios, let's insert this important guy called arbitrageurs. Arbitrageurs. What is this arbitrage? Buy low, sell high guys, right? Infinite capabilities of these arbitrageurs. If we assume that, then this guy arbitrager will make the demand curve flat. What do you mean? If, okay, you can think about Avengers kind of arbitrageurs. Iron Man kind of, I can take care of the whole world. Yeah, wait for that. So that, right? If there are too many buyers, over-optimistic guys driving up the bubble, then these arbitrageurs will short sell the stock to the infinity so that he will essentially kill the bubble. Then the demand curve will, get flat down. On the other hand, if the market is in crash, which means the investors, 99% of them are pessimistic. Oh, sell, 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 sell. Then the price gets too low. Then what does the arbitrageurs do? They are capable of buying the stock to the infinite degree. I'll take care of it. So that the demand curve gets flat. So third scenario, the existence of infinite capabilities of arbitrageurs, right? Then the demand curve will be flat. Okay, so these three scenarios, if these things hold, if these three scenarios, any of these hold, then we will see a flat demand curve for securities. But the problem is, are these three scenarios, any of these, realistically possible? Okay, that is a valid question. Okay, so go ahead and read it, and then you will see. And in this, the slides are self-evident about what I already said. Where things stood is that in 1980s and 70s, right, the economists found out some empirical evidence supporting their efficient market hypothesis and seemed very rosy. Oh, now we are setting up the whole, how do you say, punching the final point, right? 활용점정 kind of things. Finally, all the economics theory is heavily dependent on this efficient market hypothesis, and we are finding those evidence. Yes, that was their situation. Okay. Next week, next class, we're going to talk about the evidence against this EMH. It's going to be really, really fun. So wait for that. All right. Thanks for watching. See you.